Third wave and lockdown, COVID variants, vaccination, market readjustment. But what is going on right now? Have you noticed that today, with the uncertainty of the stock market, we have two different types of people? First, you have the pessimist people and the people that thinks that the market will go down, it will continue to go down and dip, and that in the next years it will crumble eventually. And on the upper hand, you have the positive people and the optimistic ones that think that the market will continue to rise and that at the end of the day it will go to the moon. Today, we'll see where should we expect the market to go in the next years. Hey, how's it going, investor? Welcome back to the North Investors, where we're all about personal finance on our way to financial freedom. First, before to analyze the market, we needed to understand a basic concept that will influence it, which is the inflation. So the inflation is the variation of the value of money through time, or the variation of the buying power through time. That means that for $1 nowadays doesn't worth as much as it did 20 years ago. When we take the example of milk, back 40 years ago, 1 gallon of milk costed around $1.12, and nowadays it costs around $3.15. So you can see that $1 in 1980 worth way more than $1 nowadays. Plus, keep in mind that with all the debts that the government accumulate through the past year due to the pandemic, the inflation is predicted to increase a lot in the years to come. So that means that we will potentially lose some buying power and the cost of life will potentially increase. Now, when we take a look at the global situation of the stock market, we can see that since the big crash of 2008, the market has been in a constant growth pattern. So since 2008, the average return on the S&P 500, which is an index that regroup the 500 biggest American companies on the stock market, has gained on average 10% per year. So we see that the last big dip that the market faced obviously was due to the pandemic. And when we compare it obviously to the dip of 2008, the market dipped from around 1,500 to almost 700, which means that the market lost almost 50% of its total value. But with the pandemic, the market went from 3,400 to almost 2,300, which means that it dipped and lost almost 30% of its total value. But the thing that is interesting to see is the fact that the market actually recovered very fast. So the market fully recovered around October and November this year to after gain almost 20% of value compared to its highest point in February last year. And when we see compared to 2008, in 2008, it took many years, so almost 4 or 5 years to recover totally from the big crash. Now that we know what is the current situation of the stock market and that we have compared it with the 2008 crash that took almost 5 years to fully recover from it, well, we can compare our current situation with the most well-known crash that happened in 1929, which was called the Great Depression, and that happened just before the World War II. At that time, most people were already not having a lot of money, and most people were already living below the rate of poverty. Well, at that time, what happened was that there was like a global market panic because the bank wanted their money back from the investors, which made also everyone panic, and that there was like a full panic on the market, which made lost the Dow Jones a total of 25% in 1 year. And what is incredible about that is the recovery time that it took for the market to fully come back from this event. It took almost 25 years to come back from it. So we see that with our current crash, that it took only 10 months to recover from it and also to surpass the point that we were last year, we see that it kind of indicate some danger alert, because we could see that potentially we have a recession or even like some period of readjustment coming soon, and that could be a great indicator about it. Plus, another great indicator to see where the stock market is going to is the value of bonds. So for those who don't know what is a bond, basically it is an obligation that has a certain company or even a government towards you in exchange of a certain amount of money. So let's say that, for example, you want to invest $1,000 in a certain company, so they can do whatever they want with it, and in exchange they are giving to you a 5% interest on a 5 years period. So that means that this company will need to pay you back during that period the initial amount of money that you put into the bond plus the 5% interest. So that means that for an investor, this represents a stable income and a fixed income that you will receive per period. And this is a vehicle of investing that is considered as a low risky, because if we compare it, for example, to a stock, well, the bond holder and the bond owners will receive their money in priority compared to the shareholders of a stock if the company, for example, goes to bankruptcy. We also know that the supply and the demand will highly affect the price and the interest rate of the bond. So the highest the demand will be, the lowest the interest rate will also be, and vice versa. Knowing that, and when we see this article, we can see that currently the yield of bonds are really increasing, which means that it will highly affect and impact the stock market. And also because as we see over here, we can see that currently the bond yield are still very low, but still they have rose to 1.7% in the US and to 1.5%, and they are still lower than the inflation. So technically you are losing money if you invest in bonds. But if they continue to rise, this will probably invite the investors to go and invest directly into bonds instead of investing in the stock market. So maybe some stocks will be hit by this situation. But when bonds are with a low interest yield, well, the bonds technically are not good for investors, because if you take and in my personal point of view, when there is some low yield for the bonds, I consider that the best bond that you can have is the great bond with your family and your friends. But if you have a bond that, for example, has 2% interest, and when you see the inflation has 3% interest, let's say, well, that means that technically you're doing money, but you're losing the power of buying, and you're losing you're losing money because you're losing 1% of your money. So it's better than doing nothing with it, but you could invest it at a place where you're really gonna do money. However, if the yield of the bond continue to increase, as we saw in the article, well, technically it will encourage the investors to go invest into it instead of, for example, keeping the money and investing it into some overvalued companies. Plus now we see that the market fully recover, even though we are still in the pandemic, and the market didn't even only recover, it surpassed its highest point when we were last year in February, just before the pandemic. So basically that shows that the market really recovered fast, and also the fact that even if here in Canada we are still stuck in the full pandemic with the full lockdown, only essential stuff are open and even schools are closed, so we're really stuck in the mud, and that shows that the pandemic is not over, but the stock market continue to really perform very well. And there is many indicators to it. For example, we could take a look at the systematic risk versus the non-systematic risk. And the non-systematic risk basically is the risk that you can diversify with your investment. For example, you invest in different places to diversify your risk and to don't put all your eggs in one basket. And you have the systematic risk, which is the risk that you can't modify. For example, the risk from the market. There is the political risk. There is the risk to the companies, the exchange rate risk. So all those risks, you can't really affect them. Also, the value of the stock market is affected highly by the value of the different stock in the market. And during the pandemic, the government were giving some different alternative and ways to help people because many lost their jobs. So they were giving stimulus check to people to help them. So the people that lost their job, and because everything was closed, they had some money, and sometimes with the money that they had left, they decided to invest. So they took that money, they invested it into some stock, and sometimes they just increase a lot the value of different stock. For example, Tesla that reached almost $900, which was caused a lot by the fact that people had some money left and they decided to invest it into it. So is this situation is normal? I wouldn't say that the situation is really normal, because as we saw in the past with this pandemic, the stock market totally recovered in really a short amount of time, and it even surpassed its highest point from the pre-pandemic. So I don't think that the situation is completely normal, and this is due to many factors, as I told you. But technically, I had seen that there was going to be like a market readjustment, and I knew it. The thing was that no one was able to know when was going to happen this market readjustment, because we can't see the future, so it's hard to predict it. But I was able to see it, and sometimes the best is to be able to adapt. So adapt your situation. For example, if bonds, the yield really increased a lot, well, maybe there will be more people that will invest into it, and that's good. And sometimes we saw that in February 2021, when the growth sector it began to just fall, and when, for example, Tesla went from let's say 900 to like 600, people were going crazy, and they all think that now was the time of the big readjustment. And sometimes those people just decided to invest, for example, in value stocks, and I had made the transition just before it. So I enjoyed the fact that they went to value stock, because I already had some value stock, so it increased of value. Value stock value. But for real, sometimes it's interesting to just adapt your portfolio to your objectives. Also, I'm not going to tell you go invest in that stock. At the end of the day, it's your responsibility. But sometimes be aware that you need to adapt your investment to your situation, and don't be too cocky about it. So if you see that you have did a lot of profit, sometimes it's better to take the profit and wait before sometimes the catastrophes happen. Oh, and guys, another strategy that you can do also is to try to buy more regularly and more frequently than, for example, buying stocks one time in a year. You can try to buy let's say at least one time a month, or even one time a week if you can. So that's going to reduce the risk, as we saw, the systematic risk of the market. So you will enjoy all the increase, and you will be sad when it's going to go down, but you will take in fact actually the fact that the market is increasing of 10%, and you will enjoy the fact that the market is increasing of 10% per year. So that's really interesting. And also to be able to hold your stock, because you don't know what's going to be the future, so you hold your stock until you do a lot of profit with it, if you can. If there are two things that we are sure in life: first, we're gonna die, and second, we can't predict the future, and no one has like a crystal ball to see what's gonna happen in the future, but we can try to do the best prediction possible. And to do that, I will invite you guys to go check out my previous video on how to analyze a stock, and you will be able to reduce with that video all the systematic risk allowed to the market. So this video is going to be just available right over here, and I'll see you there.